Time for Ask Annex. Our website is the place to go if you got a question for us, and we want to hear from everybody. Don't have to be a client. It's annexwealth.com. Look for the Ask tab. In the studio, Fred Coleman, a CFP and a wealth manager at Annex Wealth Management. Welcome.
Danny.
And we got Matt Morzy, investment team manager and a CFP at Annex Wealth Management, part of the investment committee. Welcome.
Hey, Danny.
Okay, here we go. Number one, I'm stuck trying to find an appropriate S&P 500 index fund. There are so many. How do I evaluate them?
Great question, and it's kind of amazing how many different ones that they are. How I would look at it first and foremost is what are you really trying to accomplish? Because there are going to be different ways for them to weight the same holdings within the S&P 500. So the two most common ways is market cap weight, which is basically the largest companies. So right now, think like Apple and Microsoft are going to be the biggest part of that fund. The other would be equal weight, where it takes all 500 odd names and then makes them the exact same weight. So it doesn't matter which company it is, but they all are weighted the same. There can be very, very differences in terms of what your return level is going to be in those based on, which companies are outperforming or underperforming, but you want to make sure you have the right mix of what you're trying to accomplish. After that, I would look at what the expense ratio is. If you have two identical investments and the only difference is the expense ratio, obviously pick the one that has the lowest one. You're going to get a better end return if you're paying lower fees. So I would look at those types of things. Another maybe last thing to look at is if you want to go ETF or mutual fund, you could do both. So it depends on kind of what you want to do with it. Is it something you're going to be actively trading? ETF is probably going to be a better route. If it's a mutual fund longer term, again, make sure you're looking at those expense ratios. And if you're at a custodian, they might actually have their own version of it in terms of mutual fund form where they might not charge you a buy or sell fee. Same thing with an ETF too. You might be able to trade that without a buy or sell fee to it. So you're going to want to look at see what's the most flexible for you.
Fred, I think this one's for you. If I add in the value of my home, I've got a decent net worth. But does it matter if a house is pretty illiquid?
Yeah, when it comes to a house, it's a huge asset and it looks really good on the balance sheet. And when we build financial plans out, we do include that on your net worth. However, it doesn't come into play unless you decide to sell it or if you're going to use it for some form of collateral. So if you do plan on selling it at some point, then we would build that into your plan to show that sale and how it benefits your overall outlook. If you don't plan on selling it, essentially it has very low relevance.
Would you say that like the millennials, the Gen Xers are probably in that group, right, where they might be house rich but kind of cash poor?
Yeah, a lot of people, you buy that house when you're in your 20s and your 30s, and that grows pretty substantially and becomes your largest asset. But eventually you pay that house off and your 401ks and your other investments usually catch up.
Question 3 on Ask Annex. Please settle an argument. Is the Magnificent Seven just the latest version of the FAANG stocks? Yes, I know there are 5 companies in the FAANG versus 7 in the Mag 7.
It certainly is. And we always go through these cycles where there's going to be a few stocks or a group of stocks that are going to get a nickname and then everyone's going to be talking about it. I mean, you think back to the 60s and 70s, there was a thing called the Nifty 50. These were large blue chip companies. At that point, it was always thought, hey, you could always buy these things no matter what the price is. They're never going to go down and you're going to do okay. That was the thought process for a while. But we go through these cycles all the time, late 90s, early 2000s, again, tech, just kind of like it is now. But you've got these companies that get grouped together and people love talking about them. The more and more that we have cable news shows that are all about the stock market, more and more the internet and social media takes on, it's easy for these things to get a nickname and get a following and it becomes a big thing. What you really want to look at, I think, from my perspective is, what is the impact they're having on the market? That's going to ebb and flow over time in terms of what those groups are. Magnificent Seven really is looking at the biggest companies that are out there right now, and they've had an outsized return from a market perspective over the last year or so. But just before that, it was FAANG at one point in time. But, they've got down years as well, too, and maybe a new group of stocks takes over and gets a catchy nickname, and people start following them, too.
Cool group of stocks right now, right? And not to say that they're not good companies, but one thing that I've seen with these companies is that they're trading at prices that usually reflect future growth. And you could be right, you could be wrong, but when the risk of these companies don't outperform the expectations, then you can start seeing a lot of volatility.
Is there a dirty 30? Maybe we should work on that. Final question on Ask Annex. What's the reason to buy a mutual fund A share?
Yeah, when we look at different share classes, we're investing on behalf of our clients is what is the best potential return they're going to get from a fee standpoint, when you take those out. So due to the size of Annex and the client accounts, the relationships we have with the brokerage firms, we have access to all different share types, and we can go ahead and negotiate with them what their buy or sell fee might be with them, but also we're looking for things that are going to have the lowest net expense ratio for them overall. Generally, when you think of things like A shares, for most people, if you're going to go to a brokerage firm or to a broker dealer to some extent, they're going to get a big front end load to that. You're essentially trying to pay upfront for a fee to be accessed over a period of time. When we use A shares here, there is no big load. We have what's called load waived A shares that we have access to. So there's an expense ratio that they are going to pay every single year, but not that big front end fee to it. We also have access to what's called institutional share classes, which have a lower expense ratio even yet compared to A shares. We're analyzing those on the best interest of our clients to see what is going to produce for them the best long-term result.
Matt Morzy, Investment Team Manager, thanks.
Thank you.
Fred Coleman, CFP, Wealth Manager, Annex Wealth Management, thank you.
Thank you, Danny.